Good morning, everyone. It is 10 o'clock on February 12th, 2026. Let's call the Oklahoma City Employment Retirement City System agenda to order. First item is item 2, to approve the meeting minutes for the January 8th, 2026 meeting minutes to be able to get, let's approve those minutes. Sorry, stumbling today. Get a motion and a second. Approve the item. And the item passes. Oh.
Let's get Shree's vote in.
It popped up and then disappeared.
We can open it back.
We'll open that back up.
We're just getting warmed up.
We are.
We should be able to open up the original vote and add. Let's just.
We'll just do a mulligan. All right, item 2 passes. Item 3 is the consent docket. Get a motion, a second. Get your votes. And the item passes. Item 4 is to ratify approvals for the payroll from January. Get a motion and a second. Get your votes. And the item passes. Item 5 is to ratify approvals. Oh, claims to be approval. Sorry, I got off on lines. Thank you. Get a motion in a second. Take your votes. And the items passes. Item 6 is to approve the following applications for service retirement. Get a motion and a second. Take your votes. And the item passes. And item 7 is to approve the continuation of pension to spouse. Take a motion and a second. We'll take your votes. And the item passes. Item 8 is to receive the report of death and authorize the payment of $5,000 death benefit and and approve the continuation of pension to spouse. Take a motion and a second. We'll take your vote. Item passes. Item 9 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize the secretary to make the necessary change to conform to the following. Take a motion a second. We'll take your votes. And the item passes. Item 10 is to receive the report of death and authorize the secretary to make necessary changes to conform on the following. Take a motion and a second. Take your votes. And the item passes. Item 11 is to approve the following application of vested rights. Take a motion and a second. Take your votes. And the item passes. Item 12 is for individual consideration. Item A is regarding the representation of disability line of duty. Staff is recommending, it's item 1 or 2 to enter an executive session. Staff is recommending executive session, and we'll take that at the end of the agenda.
We can go ahead and vote on it.
We can go and vote on that. So if I can get a motion to enter into executive session. If I can get a motion. A second, and we'll vote. Okay. And then item passes. And then item B is to approve the Oklahoma City Employee Retirement System staff to be able to have the pay plan retroactive to July 1. Get a motion and a second. Take your vote. Item passes. Item 13 is to receive the investment consultant reports, and we can take all of those at once. And we have Jason Poulos with ACG to present.
Thank you.
Good morning, Jason.
Good morning. Okay, oh, whoops, there it is. All right, so this morning we've condensed some of these reports, and including the monthly, the quarterly, some excerpts from the quarterly, and then just a review of the asset allocation that we do once a year. But as we discussed last month, I think big picture, portfolio returns very strong. We're coming off a third consecutive calendar year of very good equity market returns across the globe. A little bit of a change from prior years. For the first time in about a decade, we see non-U.S. equities and emerging markets as the best performing asset class. Really the better part of the last decade, U.S. large cap has dominated. Last year, emerging markets best performing asset class, followed by international developed markets. And actually the underlying company returns were very strong, but you also got a boost from the currency, a declining dollar. That diversification in currency was a benefit. More recently, as we've moved into 2026, seeing a bit of repricing in the markets. Some of the more expensive mega cap tech stocks selling off. But really seeing the index valuations holding up as there's been quite a bit of a rotation into materials, industrials, more value-oriented sectors of the market, small cap and international continuing to do well. From a relative performance standpoint, and we'll take a look at this in a minute, but here just a recap of what I was just indicating. You see emerging markets, this is through January. 1 year return for emerging markets up almost 43%. Non-US up about a little over 31%. US equity still very strong returns. 1 year return 16% for large cap and almost 16% for small cap. Through yesterday now, we're actually seeing the 1 year trailing return for small cap a little bit better than large cap, and that's been a while since we've seen that. Fixed income even up close to your hurdle rate of 7%. So when we looking across the board there and looking at 10-year returns, the green bars, 11, almost 16, almost 10, and 10, you have a required return of 7%. All of these markets on a 10-year basis really delivering a significant premium to that, to your required rate of return. As we look at go forward asset allocation, our expectations for the next 10 years don't look quite as rosy as it does in the rearview mirror. I will also say that if we went back 10 years ago and we looked at what our capital market projections were, while the actual outcome that we're seeing is within the range of outcomes, it's on the higher end of those outcomes. We've had a better than expected period, and that's to be expected. That things are going to fall in a wide range of returns. Interestingly, and your portfolio hasn't necessarily experienced this on the U.S. side. On the non-U.S. side, we're seeing a bit of this because markets have done so well. And a lot of what has led the way has been anything related to AI. the AI story, whether it be data centers, energy production, as well as some of the companies in the mega cap tech sector. That's really led the way across the board. And those stocks have become expensive, whether warranted or not. They lead the indexes up. It's made it pretty challenging for active managers to keep up because active managers are looking, they're concerned about price and valuations and probably a little bit more defensive. So what this is showing is just how difficult 2025 was for the active management community across asset classes. It's kind of hard to understand what this means, but this line, each spot on this line is end of year going back the last decade. And this is looking at the percentage of active managers in each asset class that outperformed the benchmark. So I'll pick on small cap value. At one point in time, one year end over the last decade, about 80% of active managers outperformed the benchmark, meaning active management was really adding value. On average, on a one-year basis, it's a little over 50%. This may be a little deceiving, and some may say, well, if on average only 50% of managers are outperforming in any given year, why would we be active? It's pretty hard to choose active managers who are going to outperform. If we extend this out and look at 3 and 5 year rolling periods for asset classes outside of U.S. large cap, that percentage of managers that is outperforming over 3 and 5 year periods is going up more like 65, 70%. So we think it's appropriate to have active management there. The red diamonds are last year. So in almost every asset class, it's the lowest in a decade of active management outperforming. Small cap value, only 20% of active managers outperform. Non-US value, 23%. Non-US growth, only 40%. Fixed income is a little bit different story. Fixed income managers, while returns, the absolute level of returns much more modest, and that's generally what you would expect. When returns are very high, it's a lot more difficult for active managers to outperform. Much more modest returns in fixed income, but on average, fixed income managers have been significantly generating the ability to outperform. A lot of that is due to, if you think about how indexes are created, the most expensive things become a larger part of the index. In fixed income indices, the biggest borrowers become a larger part of the index. So treasuries, US treasuries dominates the aggregate index. It's about 50% or like almost 60% of the index. Just being different from that and owning securities outside of treasuries is going to be beneficial. So the managers able to outperform. This next slide just shows looking at it a little bit different way. This is looking at the median manager. And again, I'll say this, year two, particularly in small cap, this is the area where it's been the most challenging for active management. Year two small cap managers actually did a very good job. I think your small cap composite actually outperformed over the last year, the combination of Earnest and Silvercrest. But what this is showing is that, and I keep using small cap value, the median manager last year was 5.6% behind the benchmark. So you could be a top quartile manager and still be significantly below the benchmark. It was that challenging. Already this year, we're starting to see that moderate a bit. A big contributor to this over the last 6 months in the year was just the low quality rally within small cap. We talked about this a little bit a couple months ago. If we look at the Russell 2000 index, which most small cap managers are benchmarked to, and that's what we're using as the benchmark in your policy index, that benchmark over the last 20 years has become a pretty significant low quality benchmark. What do I mean by that? 20 years ago, about 84% of the companies in that index had positive earnings or generating earnings, and only about 14% were non-earners or negative earnings. And that's concept seems silly, but these are newer companies. Today, at the end of last year, 46% of the companies in the Russell 2000 are non-earners. So you think about active managers and focusing on quality, it's pretty hard to buy companies that aren't generating positive earnings. What's contributed quite a bit to that is the growth in private equity. As the private equity markets have expanded over time, a lot of the higher quality public company, what would have been in the public market, small cap, are staying private for longer, or they're getting taken out by private companies. And I mention that because as we look at asset allocation, we're not recommending any changes to your target allocation at this time. But as your private equity allocation starts to move up toward your actual 15% target, we think we need to look at that private equity and small cap allocation in tandem and start bringing down the small cap allocation. And we can do that through using small cap as a funding source for private equity. So just, again, looking at your results, this is where you were at the end of the year. A little bit overweight to equities, as equities have done well. Slight underweight to fixed income overall, but we do have a little bit of cash. When we add that cash back in, your fixed income is about at target. A slight underweight to real estate. We do have some unfunded real estate commitments on the private closed-end real estate side. New commitment you just made to Starwood Property Fund. That will start to move that up toward that 15%. Within equities, you'll see large cap and small cap are a little bit overweight the targets. Private equity, as I mentioned, we're underweight that target to private equity. That's because we have, the last few years, from a policy standpoint, we've increased that from 10 to 15%, and it's going to take some time to get there. Just this month, we did raise some cash. The primary mechanism for rebalancing in this portfolio is your cash needs, and as you just approved, about a $4.3 million expense for monthly benefit payments. So it's about $12 to $13 million a quarter. Plus, we have to anticipate capital calls from private market funds. So we try to raise about a quarter's worth of cash. We just raised $15 million to put into cash to meet the next quarter's cash flow needs as well as capital calls. And that was taken from both small cap and large cap. We took about $9 million from large cap and $6 million from small cap. So that's how we systematically bring that down. I thought, try to cut out some of the noise, but just look at the bigger picture pieces from an asset allocation standpoint and what's contributing. And we're breaking this down, looking at 1-year returns of your major asset classes and then 10-year returns. Again, overall results very strong. The 1-year return for large cap, because we're passively implemented in large cap, we're looking, if we went back to that active versus passive page, you would see that over time, historically, it's very difficult for U.S. large cap managers to add value net of fees. It's a very efficient market over periods of time. So we're taking the return that the market will give us through a passive implementation that we're getting at a very low cost. I think you're paying 1 basis point for exposure to large cap. You see you're getting the return of the market. Over the last 10 years, a little bit lower. We did have, for a good part of that 10 years, you had another manager, Intech, which was, it was a benchmark risk controlled strategy, but it did take some deviations relative to the benchmark, and that's where that dispersion's coming from. But still, more importantly, both the almost 18% over 1 year and 14% over 10 years, well above expectations for large cap on a long-term historical basis. Your small cap, as I look across client portfolios, this is probably one of the better performing small cap portfolios we have. As we looked at active managers, only about 20% outperforming the benchmark. Your combination of Earnest and Silvercrest adding about 20 basis points. Very, very strong return results there. Private equity, we've spent a lot of time talking about this. Private equity, it's not going to look like the S&P 500. It's not public market stocks. It's going to look very different than that, the return stream. There's no benchmark for private markets. In the long term, over long periods of time, we would expect to get a premium return for the illiquidity relative to public markets. We're comparing that to the best performing asset class in your policy benchmark over the last 10 years. So that dispersion that you'll see in a minute of your total portfolio relative to the policy index, most of that is coming from private equity in the 1 year. On the 10-year, a little bit below, that's just dropped down, and I think it's probably, we're starting to see that move again as the S&P is sold off a little bit. We would, overall, your private equity portfolio has done strong returns over the last decade and since inception. Yep.
There we go. Jason, what would you expect over a 10-year period for your private equity? What's a reasonable expectation?
Well, our capital market assumption now is about 10.
10? Okay.
Which is higher than significantly higher than public markets, which you'll
Okay.
see. But it's down from historical.
Okay.
In the rearview mirror, though, Brent, I mean, that we wouldn't have expected 15% from U.S. large cap over the last 10 years. It's been a unique period. Non-U.S. equity, your best performing asset classes, your international developed combination of Lazard and Harding Loevner, and then your emerging markets, which is a combination of Allspring and Wasatch, up 26% collectively. Again, trailing the benchmarks. Similar story in non-U.S. markets, a couple different things there. Within developed markets, European banks were the best performing industry sector, up almost 60% for the year. Your two managers were a little bit underweight there. And then on the emerging market side, the combination of Allspring and Wasatch is a small cap emerging market manager, so they're focused on smaller companies. They're significant underweight to China. China was one of the best performing countries in the emerging markets, up close to 80%. They're going to have an overweight to India and India financials because they're much smaller. That contributed to some of that dispersion there.
Jason, on those returns of 26% for the year, what portion of that is attributed to just the dollar value of the dollar?
Well, if we look at the index returns, it's about 10%.
10 of the 26 or 10 or 2.6% or?
No, so I'm just looking at the index. I don't exactly know on the specifics for your managers, but from the index return, the index returns in local currency for do we have it on? Oh, it was in last month. For international developed, it's about 10%. So in local currency, the index was up about 21%. So the companies are doing well.
Right, that was the underlying part of my question.
The companies are doing very well. Currency added another 10%.
Excellent, thank you.
I think this is a good look, and it's important to keep this in mind as we're investing these dollars to cover long-term liabilities. You know, there's a lot happening. We meet every month. There's a lot of noise in the markets from day to day, week to week, month to month, but really keeping the eye on that long term. And as we look at this, these are year-end trailing 10-year results of your portfolio going back a decade. And really, if we go back to the far left here, 2016, this is taking in the period January 1, 2007 through December 31, 2016. In every period, your actual results are outperforming your policy index return. You can see there are some periods, well, it really have to go back to the 16 and 17 year end periods where we were below that 7% hurdle rate, which you have. But since then, you've been above that in every period. What happened here is effectively 2008 is coming out of the 10-year numbers. So 2008 was a year when equity markets are down 50%, bond markets are, if you had credit, you're down, if you treasuries were up, but portfolios were down about 20% in 2008. So you see that coming off, and then a big upturn. And then we had several more good years, and you were comfortably above 8%, almost 8.5% for 10-year rolling periods for a number of years. You got up that 10-year period ending 2021, almost 10.4%. And then 2022, stocks down globally about 18%, bonds down 13%. The 10-year return fell to 7.4, and now we've climbed back up. I show this because as we look at asset allocation and forward-looking expectations, you're going to see the median expected return for this portfolio over the next 10 years is about 6.6%. It's lower than, it's more in between here. But if we look at the range from the 25th to the 75th percentile, because we can't necessarily, we're not saying this is what you're going to get. That's just the midpoint of the range. This 5.26 to 10.4, that lines up pretty closely with the 25th to the 75th percentile on a go-forward basis. So it's really what the market delivers. But I'd say this is a good view. Your 1-year return, 13.5%, a little bit behind the policy index. Most of that, again, it's private equity, and a little bit is non-U.S. versus we're showing a couple different peer groups here. You're not quite there yet. Hopefully next month you can have, I'd say ideally it would be the one and only billion-dollar party, but that's probably not the case because a lot of times we might jump over that number and fall back down. I think at the end of January, the portfolio stood at $998 million. But we're showing two peer groups, the public defined benefit peer group greater than $1 billion, and then the public defined benefit peer group overall. This is, the gap has closed a bit. Still the public DB is a little bit higher in all of these periods, not on the 5-year, but in most of these periods. And the reason for that is as we look at how funds over $1 billion are allocated, typically they have a lot more diversification, more private equity, more real estate. The split between large and small is a little bit different. The split between US and non-US is a little bit different. The last 10 years, being more diversified, particularly the last 3, has been a bit of a headwind. You've still got very strong returns, over 11% the last 3 years, but diversification into some of these alternatives versus smaller plans. This public DB universe, most of the observations in that are plans under $250 million, and they have closer to 40% US, and a big portion of that is large cap. So you're seeing that mitigate a bit, right at the 50th percentile, both on a 1 and 10-year basis. So now moving to just reviewing asset allocation. We update our capital market assumptions once a year. The purpose of this exercise is really just to confirm objectives haven't changed, confirm expectations, level set expectations so that everybody understands the kind of risk that you're taking in a portfolio. Presuming your objectives haven't changed dramatically, and what do I mean by that? The time horizon for your pension fund hasn't changed. You're not a closed plan, you're not freezing the plan, it's an open plan. You're gonna have liabilities on into the future. We expect to be paying benefits to people that you're just hiring on that are in their 20s. We're gonna be paying them 50 years from now. So long-term time horizon. We need about a 7% return over time. So in order to get 7%, we're gonna have to take some risk. So there's gonna be some volatility. We need to be able to pay current retirees. So we need to make sure that there's adequate liquidity in the portfolio. So assuming none of those things have changed, there's probably not going to be major deviations from year to year in the strategic allocation. Might tweak some things on the margin. In the last few years, we did make some changes to the strategic allocation. We eliminated an allocation to long, short, or hedged equity, which had been in place for about 15 years. That allocation really came into play after 2008 when interest rates went to about 1.5%, and having a significant portion of your assets in fixed income that is going to get you 1.5% to 2% over the next decade when you need 7% would have been really challenging. So we needed to add something that had a higher expected return, but not as much risk as long-only equity. So that was added. After 2022, when rates came up, the need for that fixed income adding a little bit more compelling return, now more like a 5% return for fixed income that we can expect. So it's not as big of a headwind or a drag on portfolio results. So that long-short equity allocation was eliminated, and we actually increased fixed income, and we've increased private equity a little bit over time, as I mentioned. What you're seeing on this page, these are input assumptions. So the blue dot for each one of these asset classes is the average expected return for that asset class in any 1 year. The line around that is one standard deviation around that average. So to highlight, I'm going to use small cap, I'll use emerging markets, probably the best one to highlight. So you can see the blue dot right about 10%. We'll call it 9.9%. So that's the average expected return in any 1 year for emerging markets. So there's 50% probability in any 1 year we'll get 9.9% or greater, 50% probability will be 9.9% or less. The green line, very wide, goes from about -7.5% to about 28%. So what that means is we're very confident that the return for emerging markets is going to be somewhere between -7.5% and 27.5% in any given year. So it's a pretty wide range. Why that matters is from an output standpoint. Whoops. You'll see these over here on the far right. These are our 10-year median expected returns for each of these asset classes that you're invested in. So emerging markets, not almost 10%, it's 6.7%. So that volatility, the more volatility an asset class has, the more erosion to the expected return over time happens. So introducing that concept of volatility as well, that needs to be incorporated into the model. Bottom line, this year relative to last year, our intermediate term, and then for us, intermediate term is the next 10 to 15 years. Large cap came down a little bit just because valuations are still pretty expensive, pretty lofty there. Small cap, international, about the same. Emerging markets down a little bit. Private equity, you'll see down slightly. But Brent, to your question, so that is our expected return for private equity over the next decade, the 50% probability, just under 10%. You can see relative to other equity asset classes, there's still a premium there. Real estate, actually core real estate slightly up, opportunistic real estate a little higher. These have come up a little bit more over the last few years because we've bottomed out. Valuations are pretty low in real estate, so that's what's happening. So these intermediate term assumptions, they're anchored on current valuation, current yield, current cap rates or income on real assets. So they'll move around a little bit from year to year. Our long-term 20, 30 plus year assumptions are anchored on very long-term historical averages, and they tend not to move around very much, and they're a little bit higher. When we put that into the model, and we'll look at that in a minute, we look at different time horizons, but we think you have a realistic probability of achieving your target rate of return over time. Another lens we like to look through, because if we just look at the math, we would say, well, small cap's going to give you more than large cap, private equity is going to give you more than large, all of these things look better than large cap. We also want to just take into consideration just the opportunity set, so we're not deviating too far away from what the global opportunity set actually is. At the end of last year, from a U.S., non-U.S. standpoint, about 64% of the world market cap is in the U.S. and 36% outside the U.S. Within the U.S., the difference between large cap and small to mid cap, large cap is actually about 72% of the market opportunity set, small and mid cap, 28%. Developed versus emerging, 70% developed, 30% emerging. So we do want to take that into consideration. Right now, your portfolio, the current target is a little bit underweight US, 55, 45, based on targets. The actual allocation is a little bit different. The actual allocation looks more like this mix one. The large versus small, we're a little bit overweight to small cap. So we want to take that into consideration going forward, and this is where, I'll come back to this in a minute, but thinking about as private equity increases, because we're not at this 15%, but bringing down the small cap as a source for that. Right now, your target policy allocation, the 10-year median return for your current target mix is actually 7.5%, well above your 7% target. So from a reasonableness standpoint, I would say, what are we doing with this? We would say your 7% target return, it's a reasonable assumption. This portfolio should be able to deliver that over the next 10 years, over a longer period of time, higher. We did some education yesterday with new trustees, and one thing I commented on, and I think that the board knows, you've been a very thoughtful fiduciaries over time in thinking about that hurdle rate. And it's always going to be more reasonable to have a lower expected return. It's not that we would change the portfolio. We're not going to change the portfolio mix to get closer to 7. And we wouldn't necessarily, as long as you're comfortable with contribution and funded status today, we wouldn't suggest you increase that expected return just because this is a little bit higher. This, I think, is probably the best way of looking at it. And back to what I showed you earlier, that the actual 10-year rolling results over the last decade have ranged between 5.26 and 10.1%. So put that on here. This is forward-looking, the 25th to the 75th percentile. The expected returns somewhere between 5 and 10%, with the median right around 7.5. As we move out further in time, it's a little bit better. So again, we're comfortable with your current targets. We're not suggesting any changes. This mix one was really to show this is a little bit closer to where you are today. Your actual allocation, because your actual allocation deviates a little bit because we're not at target in private equity. We're a little bit underweight in fixed income. We're a little bit underweight in real estate. It's a little bit, we're not trying to be there. That's just where the portfolio has ended up. But from a risk and return standpoint, it's about the same. We're not taking on, portfolio's not shifted to be way out of whack. The other thing I'd like to point out, just this first percentile return, this is just for understanding and expectations. In order to get this type of return over time, you do have to take risk. So this portfolio, worst case, this first percentile return is a 1% probability in any given year. So meaning this portfolio could be down about 18, almost 19% in any given year. That's a 2008 type event. It can happen. This is probably a better way of looking at it. In any given year, this is looking at the probability of flat to varying degrees of negative, and you see that negative 18.8, there's less than 1% probability, but about a 23% probability in any given year that this portfolio could be flat to negative. So again, just understanding about a 1 in 4 chance that you're going to have a year where you're a 0% return. Does that make sense? Okay. All right. So again, no recommended changes to your target asset allocation. We're comfortable that you have a reasonable probability of achieving that 7.5% return. Any questions on that?
No.
All right. And finally, I'm not going to go through the ASAP, but just pointing out that you're just under the $1 billion mark, 998, 977. Hopefully, as we stand here today, you're probably just over that.
So do we have a party when that happens?
I think we should.
Are you bringing a cake or?
Well, that's what I said. I think we need. You want to get comfortably over that, so we don't have more than one party.
Okay.
Maybe next month. So close. All right. Well, thank you so much. Thank you, Jason.
Yep, thank
All right. We can take a motion to receive the 3 reports. Motion second. Take your votes.
Vote aye.
And the motion passes. All right. We can go then, we can take to item 14, comments from staff and board. All right, if there are none, then we can move to item 12 and we can take we can recess to item 12, executive session. All right, we are back from recess.
I'd like to make the motion on item 12A that we consider approval of the application of disability in the line of duty for Marcia Minor.
Can I get a second?
Second.
We'll take a vote.
Can you Brent was the first and Carla Spadler, or Carla?
Carla.
Carla was the second.
Okay, with that, that takes us to item 15, and it is at 10:58 for adjournment. Thank you all.